The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you. Participants in this podcast may also own the stocks discussed. For a full list of current recommendations and stocks owned by staff, members of Intelligent Investor can visit www.intelligentinvestor.com.au.
Welcome to StockTech. My name is Gaurav Sodhi. Joining me today is analyst Mickey Mordek. G'day, Mickey.
Thanks, Gaurav. Hi, Nathan.
Hi, mate.
Mickey, you just ruined the surprise. I was gonna have this great long intro for Nathan and had suspense and motif and themes and everything. And yeah, okay. Well, Nathan Bell's with us as well. G'day, Nathan.
Hi, Gaurav.
I think it's the first time the three of us have done a remote podcast. Mickey.
Well, as you can tell by my introduction, I'm clearly not
you're
that
still
well versed. So,
all right, we'll try and muddle through. Nate, let's begin with you first of all. NAB raised capital and a big chunk of capital at that. I don't know about your reaction. I was quite surprised to see the amount they raised and the fact that they threw a dividend payment on top of that also surprised me a little bit. What's your view on the NAB raising specifically? And then let's get into the banks more generally after that. I suppose other banks are probably in line to raise capital too. What's your view?
Yeah, there's a lot of aspects to this, and we'll do our best to cover a number of them fairly quickly. But you've got to remember that Ross McEwen has just come into this business, and we see this all the time where new CEOs come and kitchen sink the earnings. So I don't know, it's very hard to say how much of that he's doing at the moment, but it was certainly, I think, in his own interest to raise as much money as he thought he could at this point. And interestingly, something that certainly our former boss and my predecessor, Greg Hoffman, used to talk about a lot in the bank earnings was this capitalizing of the software expenses. And we've seen a couple of big charges for that as well. So I think that's, to me, a sign that all the banks are taking this opportunity to try and clear the decks as best they can. NAB has, and ANZ, but certainly NAB have the most exposure to business loans. And that's the reason why we've, for a very, very long time, preferred Westpac and Commonwealth Bank, because they're more reliant on just mortgages. And a lot of people say, well, theoretically, shouldn't that be the worst place to be if there's potentially a property bubble and a bust coming? But when you have these recessions, as those business loans can get wiped out very easily, whereas with the mortgages, at least you've got a chance to go and sell those homes without having to take on bad debts.
Yeah, I've heard you say that quite a few times, actually, and it's been in fact, ever since you've been covering banks, it's been our policy to prefer the two retail banks over the two business banks. And I think that really dawned on me when I took a close look at the ROEs you get from mortgages. I was quite shocked. So you have to kind of imply returns. They don't really break it down for you, but it looks to me as though mortgages generate sort of almost 30%, so mid to high 20% ROEs. Is that what you would you agree with that?
Yeah, that was the calculations that certainly used to be. I assume it's probably come down a little bit in more recent years. But one of the points I would make, and I think at the moment everyone's seeing the first order effects of this, let's say we're in recession and what the COVID-19 impact on the banks. But I think my experience covering overseas banks for a long time now is that right at this moment, we've got US banks and UK banks, and UK banks have a very similar market structure to Australia. They're actually got share prices now back towards the GFC lows, and this is 11 years after. So this isn't a situation based on massive increase in bad debts or anything like this. This is telling you that profits have been permanently impaired since the GFC for a whole bunch of other reasons. And I think one of those reasons, particularly in the UK, but the US is finding this now as well, is that the second order effect of low credit growth is that more intense competition for mortgages. And so you're starting to see NAB and ANZ talk about taking on more mortgages. And if you think of how slow mortgage growth is at the moment, imagine what that's going to be like over the next 2 or 3 years if Australians start to deleverage, if we get stuck with an unemployment rate around 10%, we see more small businesses going broke. And remember, you generally can't get a small business loan unless you put up your home as collateral. To me, that I don't think that's reflected in current valuations, and that's the reason we don't have buys on them.
Yeah, Macquarie is also pretty aggressive now in mortgage lending. I think they've taken a couple of percent market share, and they've just got into the business. Now
And
you
this is
mentioned
all on
that.
top of, sorry, Guy, I was just going to say, this is
No, go
all on
ahead.
top of just all the regular stuff that's happening with the banks. I mean, margins have been coming down for a long time. Once you get to that zero interest rate, it's very, very hard to increase interest rates from there, particularly without affecting the economy. And when you've got what we call a flat yield curve, there's really not a lot of margin to be had um, for banks. I mean, effectively, what they do is they borrow short and lend long, and they just clip the margin on that. But at the moment, long-term interest rates are effectively where short-term interest rates, so that margin's just been taken away. So when you get credit growth falling, increase in bad debts, more intense competition for those mortgages, now we're seeing those return on equity figures go sub 10%. And as someone very neatly put recently, in the past, you'd always use price to book value as a sort of base. Let's
Mm,
say Commonwealth Bank might earn 12% return on equity, or you might, in a low interest rate, environment, you might be able to be prepared to pay, say, 1.4 or 1.5 times book value. But actually, what's happening now is a NAB after this raising will be trading on a price to book value of 0.9. But if you look around the world, uh, that book value is now a ceiling and not a base for valuation. So, in the sense, I mean, that simplifies the investment equation a lot, but essentially that's saying that the banks are somewhere around fair value now and not particularly cheap.
yeah, I was going to ask you about that because we're used to seeing banks in Australia trade at pretty healthy premiums to book, and in fact, I think CBA is still sort of 1.7 or so times book. Seems crazy compared to the others. But yeah, with these discounts to book, they're not appealing yet. You still think that ROEs don't justify that discount?
I think we've just got so used to the valuations being so high, people think that just because those share prices have come down 30 or 40% that they must be cheap. And I think it's really just reality catching up with the banks. Do you know what's amazing? I remember the first bank I ever invested in when I was 18 years old was National Australia Bank. And I remember very naively getting a letter in the mail saying that it was a capital raising rights issue at $19.50. Now, remember, this is like 26 years ago. The raising was done at $19.50, and today the share price is at $16. How on earth does what was then the best run bank in Australia go through the biggest credit boom in the country's history with the biggest housing boom and 20 years on still have a share price below where it was? Like that tells you something that this investing in banks isn't the gravy train that people necessarily think it is.
Hmm. Now, the other thing that the NAB announced, along with the software charges, I noted those and had a smile on behalf of Hoff because I used to go on about them quite a bit, and we haven't seen too many write-offs until now. But the other thing they announced was impairments have gone up for the first time in quite some time, and they went up by a long way. What's your view on where impairment charges currently sit? Are they high enough?
So the actual impairment charges that have actually happened weren't actually all that much higher than where they have been. But what's changed is that management have started taking a provision for bad debts on what they expect over the next 12 months. And that's one of the big questions that you saw with the headlines in the major financial press yesterday. And I talk about in the NAB article I wrote, I talked about this extend and pretend. At the moment, the banks are trying to minimise the bad debts, and what that does is effectively allows the banks to earn their way through the bad debts over the next 2 or 3 years and minimises the risk of another capital raising. And that worked quite well in the US. But if you look back at what the actual losses were, after the GFC compared to what they were saying they were as we were just starting, they were massive. And I have no idea how they're going to work out from here. I, I mean, we're talking about at the moment, NAB's only taken a provision of, I think it was what, 1.2 billion, and Westpac have doubled that. But if you compare that to the size of the earnings these banks make in a year, like it's pretty tiny. Now, the fact that we might have 10 to 15% unemployment and a lot of those jobs have been permanently lost. I mean, Flight Centre's just closed 800, about to close 800 stores, not just in Australia, but those jobs aren't coming back. So if we get past this virus in the next 12 months or 18 months, that doesn't necessarily mean the economy is going back to where it was. And if we get deleveraging by people as well, and people don't want to have that much debt anymore, then I just don't see how we can get. Well, we're certainly not going back to those valuations, but my guess is those bad debts will continue to stick around for a while, and they're probably under provisioned at the moment. But it's just a guess because no one knows.
Hmm. We're always told that the capital ratios are really strong and our banks are well capitalized. How do you think, what do you think the chances are for capital raisings from the other three as well?
Yeah, I'm not so negative that any of the banks are going to fall over. Like even if you look at the US banks, what they went through in the GFC, they got a bit of central bank support, some government support was the TARP at the time. I expect if things got really bad in Australia, if the property market rolled over, then the government and central banks will do whatever they can to get the big four banks through. The problem is you just don't know how much capital they're going to raise and at what price through that period, which makes guessing what the valuation of these banks is going to be over the next 5 years quite difficult. My Commonwealth is the one that needs capital the least, but it might turn out to be unavoidable, particularly if they follow the same policy that NAB has and all the banks will follow. And that is, as you alluded to earlier, they'll continue to pay out a dividend even though they're raising capital with the other hand.
Is that just to release franking credits, or is that just to keep the shareholder base happy? That seems like a mad decision, really.
Yeah, my guess is it's just more to keep the retail shareholder base happy. I think there's a couple of articles pointed this out yesterday, but I think for NAB, the so just regular shareholders like you and I own 48% of National Australia Bank, and
Mm,
yet when they raised the $3.5 billion, 3 billion went to institutions and only 500 million went to retail shareholders,
mm.
which doesn't seem fair in any way.
Well,
But
it
the other
might be a
thing that
blessing that we don't get a chance. We don't get even offered to buy more of NAB. I wouldn't mind that at all. Nothing wrong with that.
And the other thing is, I couldn't tell you what the figures were for each bank off the top of my head right now, but the dividend reinvestment plan have always been very highly participated
Okay.
in Australia. So when the banks say they're paying out the dividends, it's usually half or more of that actually never
Right.
gets paid out anyway, or comes back to them. So my view is that the Australian banks are very profitable by global standards. Even in a bad situation, they can still raise capital very quickly because of they're very profitable. They can suspend dividends, and with the help of the government, which remember they blessed their funding back in the GFC, and I'd fully expect them to do so again. But the thing we're trying to work out here is how much money we're going to make as shareholders if we buy today. And if I state it quite simply, I just look at our buy list and all these other companies where I'm very certain or very confident we can make 50 to 150 or 200% in some stocks over the next 3, 4, 5 years. And I just think even in a good scenario for the banks, maybe you'll be lucky to make 10 or 12% per year, and that's in a good case.
Mm. So the case to buy, I understand, is fairly weak, and you can see that from our buy list, and that's no mystery. But what about the case to hold? Should people be selling bank shares or at least reducing their position size?
Look, I think the one thing we've told people for a long time is to keep that total exposure to, I think, is it 10%? I think we've said for a long time, and I think maybe 20% earlier on, but once the valuation started going up, we reduced that. So anyone who's followed our advice has probably got 10% of their portfolio or less in them now. But I imagine there are a lot of people out there who have just ignored that and perhaps have 20 or maybe even 30% because they've been, Commonwealth Bank in particular has been a very good holding for a very long time. And if you own that way back when from the early 90s, when it listed at $5.70, I think it was,
Mm.
you've done extraordinarily well. And I can imagine you're sitting on big capital gains with big potential taxes there to pay. So I think it's a really individual decision. I mean, investing always is anyway. But as long as you've got less than 10%, I don't think you need to worry about losing a big stake in your portfolio. But if you do have those 20 or 30%, then I, I mean, just the simple way I look at it is I just don't think that's where you want to be. I think you better, like, just this is very general speaking, obviously, but I think there are a lot of companies today who might have lower starting dividend yields than what the banks do, but they'll grow much faster over the next 5 to 10 years and give you a better total return.
Mm. Mickey, what about you? Is your portfolio chock a block of banks?
Yeah, no, well, yeah, I don't really have too much of a view. I mean, it's a pretty scary time. I think it's interesting, obviously, from the perspective of, because we're always being compared to, the index, and the banks make up such a huge proportion of that index. So I guess depending on how they perform, probably, um, is going to make up a big chunk of that. So, yeah, and I guess I was speaking to Nathan yesterday about how it seems kind of odd to keep raising money so that you can pay out dividends. It seems like shareholders are kind of paying themselves, but I guess it can make sense if you can distribute those franking credits, but I still don't totally understand it. But
the other point out of all this is just the way that passive funds in Australia aren't always the best investment choice. The way they are a great choice for a lot of international exposures. They're maybe not the best here. The index still holds. What is it, Nate? About 25% banks, and that's a lot of banks, and it's more than we've been advocating for a long time. And if you drill deeper, if you want to buy a financial ETF, then that is at least 50% banks again. So it's just a lot of concentration in an area where you probably don't want to have that much money allocated.
Well, if I bring it back to our income portfolios, I think we've all been frustrated at the performance, and rightly so, over the last 2 or 3 years at least. And I think this is the first time since I've been back at Intelligent Investor where I can actually see how our income portfolio can do much, much better over the next 3 or 4 years than what the index can do. I mean, the index is essentially made up, 50% of it is almost the iron ore companies, which you might argue are at peak earnings. You might be able to comment on that, Gaurav, even though the valuations have come back with the share prices recently. And the banks, I think, are just not going back to anything like what they were going to be in terms of return on equities at 14 or 15%. That's just not going to happen. So this, I hate using this term because it's just sounds terrible, and I hate the jargon anyway. But in terms of being a stock picker's market, I think this is actually it. I think the last 10 years you've been rewarded for just buying the market. But if I look at the market today, I don't think the market itself is actually all that cheap. But I look at this handful of 20 or 30 stocks, and I actually think they are genuinely very cheap. And that's actually exactly the conditions we want. Now, it's not going to work out over the next 12 or 18 months, but over the next 3 or 4 years, I think we can really put some outperformance on for that reason. We've talked about all these stocks before, but even just I look at Star Entertainment, where the market value is $2 billion, and yet the Brisbane casino that's going to open in a couple of years is going to cost $2 billion on its own. Now, obviously, the casinos aren't somewhere that people are frequenting at the moment, but you can see the upside that's there, and I think it's just delayed in a sense. But you can see it's going to be there. Whereas I look at what's the upside for owning the banks today, and I just don't really see what it is.
Just on those iron ore companies, I'm pretty comfortable with where the valuations are at the moment, but I don't disagree that iron ore prices are not going to go up from here, and be lucky if they stay where they are for another 12 months. All right. Anything else on banks, gentlemen?
I'll just say
Silence.
I'm recording another webinar with Evan over at InvestSMART at 9:30 on Friday, but essentially I'll just be saying the same things I've said this morning, so maybe you've had enough.
All right. Well, I had a look at a new stock, Uniti Group, which is actually it's the second time in 12 months I've had a look at this business, and it looks completely different from the first time I had a look at it. Nathan, you went to some conference and you heard the CEO talk, and you came back to me raving about it, and so I went off and had a bit of a look at it at that stage. That was about 12 months ago. Back then, Unity was a wireless broadband business, so it set up these transmission towers in different geographies, and those towers allow the company to beam radio wave signals to specific straight line points. So if you're a customer of the company and you call them up and they'll set up a little distribution dish on your roof, and it has to be within the line of sight of their transmission tower. And if it is, you get NBN free, very reliable and relatively fast broadband, without all the cables and setup costs. And that was an interesting proposition, but one that I thought was quite limited in its use, and I wasn't that interested then. The share price has climbed very swiftly since then, and so you nudged me again to take another look at it. And when I looked at it again recently, it was completely different. This business has changed. They brought in some new key executives, and one of them is Vaughan Bowen, who is He's the founder of M2 Communications, and I've heard him described as being the best deal maker in telcos. And sometimes that's a scary label, but given his track record, it probably demands some respect. In this case, he's built M2 from nothing into a $2 billion business, and it's now wrapped up into the Vocus Group. And so he's come in with a mandate to change the business and buy to buy new segments for it. So the new Uniti Group actually looks very different. It actually looks closer to what Opticom is. And Opticom, if you remember, it has been on our buy list for some time. It's a business that builds and owns fiber in new developments in estates and in residential buildings. Opticom is the market leader, and Uniti went out and bought the number 2 and the number 3 competitor in that industry and consolidated them. So most of Opticom now is actually a fiber monopoly business, and the rest of it is a hodgepodge of other businesses that I don't think are that interesting, but this fiber business certainly is. So I think this is just one to keep an eye on for the future, because there's some really sharp people involved in this, and the share register is quite interesting as well. So you got really sharp management, you've got a couple of sharp investors on board, and they've just got a mandate and the ability to change this business into something quite different, and they're doing that, and you can see that it's kind of working. That explains why the valuation looks mad to me. It's on the same market cap as Opticom, even though Opticom is a larger business in terms of revenue, and also I would say a higher quality business at this stage. So you're paying for management in the Uniti share price, and often actually paying for management sometimes can be a worthy price to pay. Sometimes management can make all the difference.
Is a
Mickey, I wanted
recession
to
good
bring.
for this business? Sorry, Gaurav. Is a recession good for this business, for a highly acquisitive business with these sort of assets in mind?
It ought to be, because its own revenue streams don't suffer. In fact, if anything, they go up as people. Well, I guess this recession is a little bit worse than average recessions, because everyone's been forced indoors, and that's actually increased the revenues that they're generating from their fiber assets. And it's also increasing people's frustration with the NBN. So their wireless business is actually increased as well, which has been quite static. They've actually stopped reporting customer numbers from the wireless business, which I think tells you a lot. But they reckon that's doing much better as well.
It
So
seems interesting though that the the valuation kind of difference that you mentioned it seems like a lot of that just comes down to people seeing the kind of earnings per share growth, and I guess if you kind of it's sort of like a roll up strategy. You're just putting on new assets, and that increases the earnings per share, and I guess people see that growth and then go, well, you can extrapolate that, but I wonder how much like efficiency gains you get by buying all these extra businesses, and I guess you get some more scale and um, things like that. Is that kind of the approach, or
Well, I think that's true with fiber. I think when you put multiple fiber businesses together, you can potentially get more scale. Um, Certainly, they've got good relationships with apartment builders, and I think actually they might be the number one in apartment builds, and
yeah,
being larger does help those relationships. I think the thing you're right about the EPS growth. One of the things that's really helped the numbers for Unity is the fact that they've also been buying on the side a lot of these little small telco niches. So they own the company that generates 1-300 numbers. So if you want to call your insurance company, you might call 1-300 insure, or your telco, you might call 1-300 telephone, or whatever. The company that adds the words into the phone number, that actually is a stunningly profitable little niche. And I think they earn about $15 million in EBITDA off a $20 million revenue line. And they've been doing that for many, many years. So there's not much growth in that business, but it's a highly cash generative business. And so part of Unity's strategy is to go out and buy these little tiny telco niches that aren't growing at all, but just generate really high cash flows. And they use that as a funding vehicle, because um, as Opticom has discovered, some of these building and owning fiber is a capital-intensive business upfront. And given that Unity actually has a fair degree of insider ownership, it's not one to want to raise equity all the time. And they have raised equity from time to time, but buying these cash generative businesses means they can generate internal cash flow to fund some of their fiber expansion. But I think you wouldn't, when you were valuing this business, you wouldn't value those little niches on the same multiple as you value the fiber business, which I think is ultra high quality and capable of scaling and growing into something quite meaningful. That's just not the case for these little niches. They'll stay small, and I can't see them getting much bigger. So yeah, I think there's a definite valuation mismatch between Unity and Opticomm, and that mismatch is why Opticomm has been on our buy list in the past, and Mickey, it's a business that we still quite like, and why Unity for the moment is on the watch list. I think at cheaper prices, Unity offers optionality that other companies in that sector don't, especially with what management might be able to do with it. But you don't want to be paying too much for that, really. And these valuations, for me anyway, I think Opticomm looks way better. What are your thoughts, Mickey, as the analyst?
Well, I guess like one of the other things, as far as I understand it, is Unity's focused more on the multi-dwelling units, so apartment blocks and things like that. And I guess one of the attractions with Opticomm, for example, is that it's quite well insulated from the threat from 5G because it's kind of further out into these newer states that are built further from metropolitan areas. So I guess there's that, and and also once that infrastructure is in place in a new estate, I think it's just harder to get another network into that than it is maybe an apartment building. I think you can potentially still get another network into an apartment building. It probably wouldn't be cheap or anything, but it's perhaps possible. Whereas, actually digging up streets and installing new pipes and all that, into a new estate is a huge job, and probably and there's no one really to pay for it because the developers pay Opticomm up front. So, and I just think as well, less acquisitions means probably maybe less can go wrong as well. Whereas like maybe it means the upside is maybe it's not going to grow as quickly, but it's probably also not going to take on a lot of debt or get itself into in any big problems, hopefully.
You mentioned that Opticomm builds physically larger networks for estates, and that brings with it quite a few advantages. You can actually add on additional layers of services once you have sort of a larger network. You can add things like smart meters, smart lights, smart traffic lights. There's a whole lot of things you can add in estates that aren't really available for apartments, and that can add more service revenue streams in the future. And I know Opticomm is already building the capability, even if they're not collecting the revenue for that. So that's a source of upside that Opticomm has that maybe Unity doesn't.
So and I guess they've just built out that because they were kind of one of the first movers. I think they even started building these, some of the infrastructure for these things before the NBN. So they've built up a lot of expertise. They've got relationships in place with existing property developers, and so I guess just having that track record behind them. And the large network, because they've obviously got to pay for a lot of fixed costs, and so spreading those fixed costs across a larger number of users means that they can probably be more competitive as well on price.
One thing that
actually,
Sorry, go ahead, Mickey.
Oh no, I was just going to say, and just the processes as well internally in terms of knowing how to build these things and knowing how to do it cheaply, and so I think. So from all those perspectives, but I don't know Unity as well as I didn't know Opticomm though. So
one thing that came up in Unity's presentations was in one presentation I was looking at, they mentioned that they are the second lowest cost provider of actually building fiber into new apartment blocks. And they mentioned, I assumed that Opticom would be the lowest cost, but they actually then went on to specify no one can build it as cheap as TPG, which I thought was an amazing admission.
Mm.
Now, I just think, again, just reminds us that TPG, a lot of these new telcos are quite interesting and they have good trajectories and some of them have good prospects, but TPG remains just an amazing business. And uh, even very skilled management with very specific niches struggle to compete with TPG. So I think that's always in the back of my mind. Every time I look at a telco, it's that the TPG just
Yeah.
almost always does it better, does it cheaper. Sadly, it's not quite on the buy list yet, but it's not far away either.
What's the share price at the
Um,
moment, Gorath?
it's about 740, 750, and
Okay, not too
I'd
far away.
upgrade it. Yeah, not too far away. I guess if you don't want to be too greedy, it's not an awful price, but I feel as though we can be greedy a little bit with that one for now.
All right, you better not give me enough of an opportunity to complain about TPG on the
Oh yeah,
podcast
that's
because
right.
we better move on.
Yeah, Mickey's an unhappy customer for the moment. Nath, both those stocks are probably not liquid enough for the funds. So, if for people wondering why we're raving about Opticom and yet don't have it in the funds, just a quick explanation for that.
Yeah, we can only have so many illiquid positions in the funds at any time anyway, because we always want the funds to be nice and liquid for lots of different reasons. But those two in particular are very small, and it's always been the irony at Intelligent Investor where we have to wait for stocks to go up 2 or 3 times before we can start covering them, which is really frustrating. But just on a general point, I know most of our members are want pretty risk-free, and I know risk-free is the word, low-risk, mature type portfolios for income. I know that's what a lot of people are looking for. But just to those who are at the opposite end of that spectrum, I think at the moment there's just just what I see, at least a handful, if not a dozen or so illiquid stocks that are very hard to get into, even funds of our small size. And I just think if you've got the next 10 or 15 years to be looking ahead and ride through another couple of cycles, and you're not the sort of income type investor, which is probably most of our members, there's a bunch of liquid stocks at the moment that are trading at very, very low valuations, but are just almost even uh, too small for us to cover it all in the newsletter. And if you know, and I think Unity is probably a potential example, and Opticom's another one. One I've been buying, I bought myself a little while back, is Molus, which is almost like a mini version of Macquarie Group. Like there's hardly any shares trade, but if you're an individual, like it doesn't worry you. You're not trying to put, unless you're very lucky, tens of millions of dollars or millions of dollars to work. And I think that illiquidity at the moment is perhaps probably up until at least the last couple of weeks, you're getting a massive premium for taking on that illiquidity. And RPM Global would be an example. Um, TGP, so 360 Capital, which at one point on the day the market got to the low, about what was it, probably 6 or 7 weeks ago now, it was trading at a 20% discount to the cash that's expected to be on its balance sheet at 30 June. Now that was all caused by someone getting up early in the morning and sold about $40,000 worth of shares, and clearly was panicked. But it was probably just someone sitting at home trading in bed or on the couch. But it was just because it was in a liquid stock, it just had an outsized impact. But just the huge reward for taking on that illiquidity risk, it was just, you don't see that very often. Maybe you see it once every 10 years. So I just think if you're looking as an investor, the sorts of things, or an edge, as we call it in the jargon in the industry, the sorts of advantages you have over the professionals, I think that's one where if you can afford to buy those sorts of stocks, or that suits your risk tolerance, it's a really interesting place to be looking.
Yeah, no, I second that as well. We've written a couple of ideas labs actually of businesses that are, for one reason or another, haven't or can't go into the newsletter. So that might be worthwhile fishing in that ideas lab pond. Now, I'm glad you brought up liquidity because the next stop we're going to talk about, Mickey, is Ale Group, which is, I think you've actually upgraded that and it's a buy now, even though
Yeah.
pubs are all closed down and there's very little prospect of reopening them. Now, the same scenario is true with retailers and shopping centers, and retailers have been howling at shopping center owners, demanding discounts, and in some cases threatening not to pay rent at all Has
Yeah.
that been the case for pubs and ale group?
Yeah. So I guess there's a few differences because so the government, like shortly after the coronavirus hit, um, implemented a new code of conduct for commercial tenancies, and it kind of applies to businesses that are seeing a decline in turnover, and basically it means that the um, landlords have to accommodate that, and they have to reduce the rent by the amount of the reduction in sales.
Hmm.
And but that agreement only applies to businesses with a turnover of under 50 million. So obviously ALH is not that, given it's much larger. So there's not a lot of guidance, in terms of what how this gets worked out. If the pubs are shut, it's basically just you've got to, if they do want to negotiate it, then they'll have to communicate that to ALE, and I suppose that they'll have to work out what happens. So there was a couple of things here that are probably specific to ale, that maybe give it a bit more protection. And so I was talking to JC the other day, and one of the interesting things is that because these pubs are so under rented already, unless you're going to ask for fair rent across all the properties on the other side of this, how can you kind of selectively ask for leeway right now? Because you've kind of been underpaying all this time. Is it fair now that you come to the table and say, well, we want a discount because because of coronavirus? Well, then maybe you've got to rip up all the contracts and say, well, we're starting again.
Hang on. So let's just back up for a second there, Mickey, because
Yeah.
there's some history there that people may not be aware of. So so
Sorry. Yeah.
ale actually came out of ALH, which is just hang on, you explain the story. Tell us why ALA it may be earning less rent than it's entitled to,
Well,
and what's going to
yeah.
make that change.
So basically, Ale owns all these. I think it's 86 pubs basically, and they're leased to ALH. And when the
And just
contracts,
explain what ALH is for those.
ALH is it's owned by Woolworths. Well, 85% owned by Woolworths now, and it runs the pubs and the retail liquor stores, essentially.
Is that going to be split out into Endeavour drinks as well?
Yes, that is the plan. I think that's been put on hold for now.
Right.
So yeah, it doesn't matter too much who the tenant is at this stage, because it's still pretty much going to have the Woolworths backing behind it. So, but yeah. So essentially, when it was spun off in 2001, the contracts were written so that you only get CPI increases. But the earnings of the pubs have grown much faster than CPI, and in return, Ale doesn't have to spend anything on property maintenance. It's all managed by the tenant basically. But what that's meant is that ALH has spent lots and lots of money, renovating, improving these properties, building new retail liquor stores on top of them. So the value of the sites has increased dramatically, but the rents have only increased at CPI.
Yeah.
And so I guess that's kind of why we say that they look quite under rented. Nobody knows exactly how much, but it's probably quite significant. And so
when is the first time they're allowed to charge market rent? I think that's an upcoming date, isn't it?
Yeah, so that's 2028. So there's one rent review from last year. Oh, sorry, from 2018. And that's still being resolved. But that one's capped at plus or minus 10% on all the properties. And then there'll be one in 2028 when it just reverts to market rent.
And our expectation is that market rent could be up to double the current rent. Is that right?
Potentially on some of the properties, definitely. Not all of the properties. Some will be worth less, but maybe I think we've said in past articles or past reviews that it might be, our estimate is maybe 60 to 80%, but I mean we're kind of that was pre-coronavirus, so we don't know what the future is going to look like, but yeah. So So I guess that's an interesting point. How does that rent? How do you stop paying rent if you've been underpaying all these years? And I think the other side is just that their retail operations will be booming.
Well,
So
that was my other question actually, because a lot of these pubs now have substantial retail sites attached to them, and so it's not as though the pubs are generating zero revenue with which to pay rent. You've got these substantial retail sites, and the sales have held up quite well, right, Mickey, in those sites?
yeah, I mean, I've been reading articles about in the SMH how people getting $750 from the government and heading down and buying a couple of cases from Dan
Oh,
Murphy's or
you've been
whatever it is.
reading articles about that, have you?
Don't worry. I'm looking forward to pubs reopening. Let's just put it that way. So, but yeah. So I mean, so that's kind of the situation, and I guess we get Woolworths results. I think it's next week. And so we'll keep an eye on those. But I think it's probably going to be a very good quarter for those retail liquor stores.
I
Most
think
likely.
this is a really interesting situation because I think AIL is potentially getting lumped into a whole lot of other landowners who are really struggling with their tenants revolting. Not that the tenants are revolting, but their tenants are saying we're not going to pay rent or we demand discounts. And as you rightly point out, Mickey, um, ALE is a very specific case where their tenants have actually been underpaying them for a good part of 20 years. So that argument is quite hard to sustain. And I think that has been lost by the market, who's just lumping it in together. An example of the counter argument, Mickey, might be Scentre Group, which probably has been over earning for a very long time. And its customers, well, its tenants probably have a very strong case for demanding lower rents. How do you think that scenario will play out?
Well, I guess there's lots of headaches that need to be worked through. It's not going to be simple. I think just in these situations, that you've got to look for where there's maybe a mismatch in terms of the fundamentals and the price. And I think, like for ale, for example, the price is down 25-30%, but maybe the fundamentals haven't really changed all that much. Whereas Scentre Group, the price is down 50% or whatever it is, but the fundamentals have gotten probably much worse. And so you're kind of making an argument: is it 50% worse? Is it 30% worse? Is it it's quite a difficult thing to work through. So I guess just those headaches, they're not going to be easy to solve. Like just big chains closing all their stores, refusing to pay rent. I guess some people argue, you can just take the hit for a year and add it to your debt, and then everybody gets going again. But on the other side of this, consumer confidence probably won't be where it is. Many small retailers probably won't survive. Myer, the big discount, big department stores, they could reduce their footprint, or and that can activate co-tenancy clauses and other issues. And then obviously you've got online as well. There's lots of operating leverage in these businesses as well. So there's just a lot of issues to work through there, and it's just complicated. And I don't
The
think anybody.
valuations here are quite
Yeah,
interesting, though, because Centre is now trading, I think it's less than half, about 40% of tangible asset value, and AIL is trading at a small premium, which is probably right when you consider that the value of their properties actually may be higher than what the cash flows suggest.
yeah.
Do you think either of those? I mean, we've got a buy on AIL, and we don't really have strong opinions on Scentre Group for now. In previous podcasts, we've sort of talked about Scentre Group a little bit. What are your thoughts on Scentre Group? Is it one that you're keeping an eye on? Is it one that you're tempted by, or are you just terrified by it all?
Well, you can make an argument everything has a price. So I think that's a valid argument. So if anyone else in the team was in favor of upgrading it, they more than welcome to take it. But
Way to pass the
but
buck, Vicky.
Yeah.
But yeah, I mean, I've done some of the numbers on it, and so the current yield is, I think, 11% or 10.5% based on, last year's dividend. And so, if I think you've just got to look at the different scenarios. So I went through and did a couple of examples. So if you take a 10% decline in rental revenues, and that would mean, a knock-on in valuations, then and assuming you have to, raise some money to reduce your gearing, then maybe you get your yield back to 8.5%. But that's including, that's assuming a 10% decline in rent. If you assume, a 20 or a 30% decline in rent, gearing could go as high as, 40, 50%. And then you've got to raise a lot of money. And so, you're looking, at a yield maybe of 4 to 9%, depending on which scenario plays out. So, maybe that's attractive. That probably is quite attractive to some people for these assets.
What are you expecting in terms of capital raisings, Mickey?
Well, I struggle to see how they get away without raising capital. Because on the other side of this, valuations are already under pressure before coronavirus, and so after coronavirus, I don't know exactly, but it depends on how much rents decline, what happens to those valuations. But if you might have to raise anywhere from, say 1 or 2 billion up to, maybe 4 billion. Maybe, and so that's going to hit your yield. I mean, there are scenarios maybe where it gets through without a capital raise, but I don't know. What do you guys think?
Well, I've bought a little bit of Scentre Group, mostly for the capital raise. I agree. I can't see how they get out of this without a capital raise, and I'm a bit surprised they haven't pulled the trigger on one. Although it must be really difficult to raise capital, sort of at half your asset value. It's probably a painful thing for them to do, and they're probably delaying it as much as they can. But I think one is inevitable. So I kind of want to be prepared for that, because I think these are ultimately very good assets, and even if they won't be as good as they were in the past, they're strategically located. It's still the place for physical shopping, and I don't think physical shopping is going to be dead. So I'm interested.
Yeah, I heard Alex talking about it last week, and I think he mentioned he bought it at $1.50, which I think is at that price, the equation probably does start to make sense. So I guess it is just a question of price, but yeah,
it might also be one of those ones where you want to take a little stake now, and maybe you get access to a share purchase plan or something to increase your stake.
Yeah, that's the plan, Nate. Yep, I agree. Yeah,
I've done it for Star Entertainment. It doesn't look like it's forthcoming, unfortunately.
Ale is also quite interesting as well. I think that's it's always been one that I think doesn't screen really well as a yield or property stock, but there's actually quite a lot going on there, and we have to be patient for those returns, because the bulk of your returns are going to come in that 2028 rent review, where suddenly I think revenue or rent will start increasing quite a bit, and we have to be patient up to then. But it's a great bunch of assets.
Yeah, and lots of redevelopment potential as well, down the track. If AL ever needs to knock down a pub and build something else, it's pretty easy to do. So, and they're well located.
Well, there's plenty of people who basically live at the pub anyway, so all you have to do is add a bathroom and a kitchen, and you got your apartment right there. Nathan, we don't have exposure to either of those in the funds. Any thoughts on either stock?
No, not a lot, but just for anyone who's been with us since back with the GFC, they might remember I did a heap of work on what's now Scentre and Westfield, and I was publishing spreadsheets in the article so people would have a play around. And the two things you've got is, one, you got the debt issue, but it's across the industry, it's just nowhere near what the issue was during the GFC. With every downturn, you have particular industries that are more impacted than others. During the GFC, the REITs just got told they had too much debt, and even if their assets were good and performing well, which the Australian ones in particular did, the banks just said, we're not accepting 40% debt to assets anymore. We want you to get it down to 30. And so they did. So they raised all that money, and it was quite dilutionary for a lot of businesses. You haven't got that problem this time around. I think any capital raisings will be far more limited anyway. But the other thing, I think the bigger problem you've got this time is just the rents that your specialty retailers are prepared to pay. And Westfield used to publish a report every 2 years. I don't know whether they still do. And you could actually go and work out how much rent per square metre the specialty retailers paid compared to the anchor tenants. And when I used to do the calcs, it was 6 times more. So
Wow.
remember, it's only over a much smaller floor space, but you get a sense of where all the profit comes from. Because essentially, you build it's like a toll bridge. You build a shopping centre, and then you fill it with anchor tenants and maybe a few specialties. And I don't know what the exact number is, but maybe it's 75 or 80% occupancy. You cover all the expenses, and then the last 20% is all cream, and the cream is all those specialty retailers who are prepared to pay those big uh, rents per square meter. And if they're all not going to pay those, maybe if the number drops from 6 times to 4 times or 3 times over the next 5 years, then all that comes off the bottom line. So it doesn't take much of a fall in revenue to have a much, much bigger impact at the bottom line. Essentially, that's what we call operating leverage in jargon. So that's probably the thing I'd be more worried about than the balance sheets.
Yeah. If everyone is concerned about their structural change to online, and that has no question accelerated. You look at the numbers coming out of any online retailer now, and they are just flying. But I think what's sometimes missed is just the optionality these shopping centres have. And you can see it every time you go into one that there's dental surgeries and doctor surgeries and cinemas and heaps of fooderies. It's not necessarily about selling, specialty retail anymore. There's a whole lot of services that can be conducted out of Westfield shopping centres. And I'm not sure that's people are caught up in the structural change without really thinking about the response. I think the valuation really reflects that fear. So I'm interested.
Well, you saw the Lowy family started selling out of the more shopping centres that were less well located.
Oh yeah.
A number of years ago, like I guess I wouldn't call them B grade malls because they're still Westfields, but the ones that just not those core ones sitting on top of big transport sites like at Bondi Junction or in Pitt Street Mall. And so I think they were the last things that the Lowy sold out of. So there's still an enormous amount of value in those. It's just trying to work out exactly what that value is. But obviously, if you're looking at those malls that are further out, a bit more regional, they're the ones I don't think you really want to own. I wouldn't say there is always a price for them, but in a somewhat normal, rational market, they're the ones that I'd be staying away from.
Yeah, completely agree with that. Right, Mickey, anything else to add?
No, not really. I think we covered it off pretty well. So.
Yeah, and I'm impressed that you're able to complete without having a rant against TPG, which you've been doing on almost every email correspondence we've had. So that's great.
Well, I'm actually thankful because we always talk warn, and this is an old Buffettism, but he always warns that the best investment ideas don't generally fall into your mailbox. And funnily enough, I'm a customer of FuseNet, which is owned by Uniti Wireless, and I did actually get an offer at 20 cents a share in the IPO, was it last year? And so just on this one occasion, a great deal did actually land in my inbox. But when it listed, the business didn't look anything like what it does today. Vaughan, Bowen, and all those other guys weren't involved at all. And I just looked at this, and as a small internet retailer, because we were living in Meriton building, and so up until the NBN, we've had to use FuseNet. You had no choice. And I'm actually very thankful because TPG sent us a letter the other day saying we can now get internet from the NBN from them for $60, and I got a 10% reduction from FuseNet. So one, you need to be careful about the future profit margins at Uniti, but also TPG, do me a favour. I didn't have to change, so thank you.
Yeah, they're almost always the cheapest, those guys. It's amazing how they do it. Anyway, no more fawning on TPG. I don't even own that stock yet, and I'm still. It's one of my favorite businesses. I still don't even own it.
You got to back smart people.
Yeah. All right, gents. Great to have you both on board. Mickey, thanks very much for joining us.
Thanks, Gaurav. Thanks, Nath.
Thanks, Nath, for your time as well.
No worries. Thanks, Gaurav. Cheers, Mickey.
For everyone else, thanks for listening.